Sector rotation can be a powerful strategy in investing, but it's not without its risks. Let's dive into the key challenges you might face and how to manage them effectively. First up is timing risk. This is the risk of getting the timing wrong when you switch from one sector to another. Imagine you've done your research and you're convinced that tech is about to take off. You make your move, but what if the market doesn't respond as you expected? You could end up buying high and selling low. To mitigate this risk, consider using a systematic approach. Set specific criteria for when to enter or exit a sector based on market indicators rather than relying solely on gut feelings. This way, you can make more informed decisions and reduce the emotional roller coaster that often comes with timing the market. Next, let's talk about market sentiment risk. The stock market can be heavily influenced by news, trends, and investor emotions. If the market sentiment shifts unexpectedly, it can lead to rapid changes in sector performance. For example, a sudden geopolitical event can cause panic selling in certain sectors. To navigate this, stay informed about broader market trends and economic indicators. Diversifying your investments across sectors can also help cushion the blow when sentiment shifts. Remember, it's not just about picking the right sector. It's about understanding the market's mood. Now, we can't overlook sector-specific risks. Each sector has its own unique challenges. For instance, the energy sector can be heavily impacted by fluctuations in oil prices, while the healthcare sector may face regulatory changes. To manage these risks, conduct thorough research on the sectors you're interested in. Understand the key drivers and potential pitfalls. Keeping an eye on sector-specific news and trends can help you anticipate changes and make timely adjustments to your portfolio. Liquidity risk is another important factor to consider. Some sectors may have lower trading volumes, making it harder to buy or sell stocks without affecting the price. If you're heavily invested in a sector that experiences a sudden drop in liquidity, you might find yourself stuck with assets you can't easily sell. To mitigate this risk, focus on sectors with higher liquidity and consider using limit orders when trading. This way, you can better control the price at which you buy or sell. Lastly, let's discuss psychological risk. Investing can be an emotional journey, and sector rotation can amplify those feelings. Fear of missing out or the anxiety of losing money can cloud your judgment. To combat this, develop a solid investment plan and stick to it. Set clear goals and remind yourself of your long-term strategy during turbulent times. It's also helpful to take a step back and assess your emotions regularly. If you find yourself making impulsive decisions based on fear or greed, it might be time to reevaluate your approach. In summary, while sector rotation offers exciting opportunities, it's essential to be aware of the risks involved. By understanding timing risk, market sentiment risk, sector-specific risks, liquidity risk, and psychological risk, you can develop strategies to navigate these challenges. Stay informed, diversify your investments, and keep your emotions in check. With the right approach, you can effectively manage the risks and make the most of your sector rotation strategy.